Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Today, we have a special set of episodes coming up, and this will be the first in many. So we just wrapped up our CLO award show after our annual CLO conference in partnership with the LSTA. And so we wanted to highlight some of the winning managers and their firms on the podcast. So today, first up, we have Monroe Capital. And Monroe was awarded with Boutique Private Credit CLO Manager of the Year for less than $5 billion and Innovative Private Credit CLO Manager of the Year. And joining me here is Seth Friedman. And Seth is Managing Director, Head of Structured Solutions at Monroe. Seth, it's really, really great to see you. Congrats on winning the awards, and looking forward to our conversation.
Thanks for having me on, Todd. Greatly appreciate it.
So, if we just stick with the awards theme for a minute, and then obviously we can go into the market and kind of where the CLO market is today, especially from your perspective. But, what do you think differentiated your platform, and what does it mean to win, awards like these?
Sure. So first, obviously, we'd like to thank everyone who voted for us in those two categories. It is truly humbling. I do think Monroe differentiates itself to our fellow members for a few reasons, but the biggest is likely Monroe's history of providing attractive investment opportunities. And we've done that consistently over 20 years. So Monroe closed its first CLO in 2006. And over the past decade, Monroe has brought to market 15 new issue middle market CLOs, in addition to a number of resets and refinancings. And that always helps to keep Monroe top of mind when thinking about middle market managers. We've also issued various types of structures that fit best with our current asset types at the time. We've done your traditional middle market CLOs selling bonds through BB. We've also issued private CLOs with a small set of investors and tailored indentures to go along with the structure. So when you can offer the market different asset mixes along with different structures, you can kind of capture the attention of not only the private credit CLO investors, but your peers as well.
The two awards, obviously boutique, innovation, they're not necessarily always paired together, but how does Monroe balance, scale, discipline with innovation?
So I would caution that Monroe is likely to pass that 5 billion mark sometime this year. So it's not as if we're new to the scene.
Yeah.
But despite being a longtime CLO issuer, we have been very measured through our history in how we deploy CLO capital. We've been waiting for the appropriate timing and asset mix. And when we do bring a deal to the market, we believe we're providing a product our investors are going to be interested in at the time. Perhaps that makes us creative in how we package our unique pool of assets, but I think the reality is that when Monroe tries to be creative and innovative, at the end of the day, we're simply structuring and providing products for our longtime investors.
You've mentioned obviously middle market there. You talked about, creativity, structuring. When it comes to the importance of middle market focus, in terms of a differentiated CLO performance? How important is it?
Well, I think that's a huge portion of why Monroe is able to issue the CLOs the way it does. So if you look at many of the league tables, Monroe is kind of tops as it relates to lower middle market loan originations. And 80 to 85% of those loans, Monroe is the sole lender. And so if you actually look at our larger competitors in this market, a lot of their deals have overlap with other of our competitors because they're clubbing up when they're doing these traditional middle market or upper middle market deals. So what that allows Monroe to do is kind of provide a CLO with underlying loans that you're not going to find anywhere else in the market. And so it offers our investors kind of a more diversified exposure to direct lending when they include Monroe in their investment mix. So that's all to say that lower middle market is what drives Monroe's originations and its CLO issuance.
Private credit CLOs obviously have moved from a very niche part of the market to, what seemingly seems to be, mainstream. What's kind of driving that surge in demand? And I think somewhere around 25-30% of the market today, right?
Yeah, and I think the surge in demand has increased over time as investors kind of get more comfortable with middle market direct lending and private credit. And it's more about the evolution of the CLO offerings. So when CLO technology was first created, it was larger banks collateralizing the loans off their balance sheet in the form of BSL CLOs. Then after that, and once rating agencies began to expand their methodologies for rating different size companies, the market then created middle market CLOs. Now, as direct lenders started to emerge and prosper, they looked for additional ways to raise capital and further leverage their current pool of loans. And that's how we got private credit CLOs. So given over the long period of time, the CLO structure has proven to protect its rated debt investors due to the OC test, triggering note amortization during times of elevated stress. I really think it's just a matter of time before CLO investors move downstream or further toward Monroe's asset class.
And the shift towards, private credit structures, I presume, given where the market has gone and where it continues to go, that this is not just cyclical. This is kind of a permanent shift.
No, you're correct. I do think this is a permanent shift simply because it's an efficient alternative to ABLs for this asset class, and because the technology has proven over several decades of track record. Additionally, like a larger percentage of the private credit deals are being collateralized in private credit CLOs. And while we don't expect private credit CLOs to overtake all asset-backed lending, we just believe it's an important part of a healthy fund finance division that uses diversified options for leverage. So it'll be around.
In today's market, we look at investors, whether they're LPs or CLO investors, when it comes to kind of their focus, what's top of mind, yield, downside protection, transparency, everything and all the above?
So I don't think you're going to find a sophisticated LP or investor that isn't currently focused on all three of those aspects. But I'll say that there's been an increased scrutiny on the manager's default and recovery track record and underwriting standards. Investors in private credit CLOs often are not underwriting the individual assets, but the processes and the competencies of the asset manager. So this would make it appear as though downside protection is the main focus. But Monroe has also seen an increase in underlying asset data requests over the past few years, as well as requests when possible to see the private credit estimates for the underlying loans.
So with obviously growth comes scrutiny. What are the biggest misconceptions that investors still have about private credit CLOs?
Yeah, so, and this is kind of going to go back to a lot of the conversation that we've already had, but I think funny enough, the greatest misconception is that middle market CLO and private credit CLOs are the same. And while they're not mutually exclusive, I don't see them as the same. They're different types of securitizations that are tailored to that particular pool of assets. So the middle market is a large swath of borrowers that all get very different treatment in their credit documents. We happen to issue lower middle market loans, and the private credit CLO structure is what provides us the most flexibility to manage those portfolios. The middle market is actually a pretty big asset class. It goes from lower middle market So companies with EBITDA anywhere from 5 to 25 million through traditional middle market, we'll call that 25 to 100 million in EBITDA, and all the way up through upper middle market, which a lot will classify as up to 100, 250 million of EBITDA. Private credit just indicates that direct lending was the source of the loans that populate the CLO. So it can be a combination of all three types of middle market loans, and then the structure is just tailored to the underlying asset mix.
In terms of institutional demand for CLO liabilities or equity in private credit deals, is there more for one or the other?
Uh, Listen, I think that it really depends on your investor base. The rated debt is always going to be more the institutional investors.
Yeah.
You'll get the sub-investment grade, double Bs, single Bs, where you're going to be more looking at hedge funds, high yield investors. And then you'll get the LPs who tend to be family offices or other high yield investors that have a very sophisticated way of looking at a portfolio to get themselves comfortable with the significant leverage that they're going to be looking at when they close a CLO. So I think the easiest investor to bring in is obviously the rated debt, because the technology has proven itself that that debt is very safe. And then when you get to the double B and single Bs, even there, the default rates are exceptionally low. So you still have a high level of comfort that those yields and the risk reward is where it should be. Listen, I think, equity is always going to be the hardest tranche to raise, simply because you have to find very sophisticated investors who can look past the leverage points and are simply looking for that anywhere from 15 to 20% yield that you're going to get in middle market or private credit CLOs.
There's been a lot of convergence amongst a lot of different markets these days. It feels like everything's converging into one or the other. And so when it comes to obviously BSL and private credit CLOs, do you see a further kind of melding of whether it be technology, data, investor bases? I'm sure you're seeing some of this already, but are we going to continue to see this trend?
So I'm not of the opinion that private credit can kind of utilize the same BSL technology, just because private credit is too hands-on to utilize that sort of AI type of technology. I know many BSL managers are implementing AI trading platforms, but it's not that simple in private credit space due to just the illiquid nature of the loan. So the winners and losers of the BSL CLO managers are often determined by trading, where it's not as much about the underwriting. In private credit, much more is relied on the underwriting because of the fact that those loans are less liquid. Monroe does strive to be as transparent as possible, but there's always going to be a fundamental difference in the amount of information available to the market between broadly syndicated and private credit loans. What I'll say is that based on our most recent marketing efforts, BSL investors are showing more interest in the private credit CLOs. Now, they're still trying to get over some of the transparency concerns, but as long as there's that pricing premium on the rated debt, I expect we'll start getting a lot more interest into this investor pool.
One more question before we jump into a couple of fun questions and wrap up. What should the market be underestimating right now, either about private credit CLOs or even about Monroe and your capabilities?
Yeah, and I'd have to say that's the resilience of the middle market and lower middle market loans. The asset class and its lenders have been through numerous economic cycles, and we have confidence based on our 20-year history that economic conditions ebb and flow, but the type of loans we originate are fairly consistent. And this is an asset class that's structured for every economic environment. Monroe's originated loans always include a financial covenant, and we're quick to intervene when we see softness in a borrower's financial performance. So in our experience, early intervention and active dialogue with borrowers is critical to achieving the best outcome for our investors.
Couple of fun questions, rapid fire as we wrap up here. Favorite sports team and or hobby?
So I'm from St. Louis originally, which means I am naturally a Cardinals fan. And I'd have to say throughout my life, that's been the most important team for me. I'm also an Indiana grad, so obviously our long storied football program is now up there as well.
Well, now you certainly got more stories for it these days. One surprising thing about yourself.
I mean, you're talking to a guy who's head of structuring and CLO securitization compliance, so I don't really think you're going to get too much surprising and fun things out of me there. I was a COVID wedding. We tried to get married. My wife and I tried to get married 3 different times. Eventually, just did a small outdoor wedding. We had a beautiful honeymoon planned in Italy, which ended up being in Maine and New York. So, everyone's had to roll with the punches, certainly during COVID, and I'll stick to
Indeed.
that one.
One book to read that you'd recommend reading.
Well, I'm the father of a 2 and a 4-year-old, so mostly what I'm reading right now is Baby Beluga or Timmy the Tiger or any of those. I don't get too much time to read now. But historically, one of my favorite books that I had read back in the day was called Guns, Germs, and Steel. And it's kind of a nerdy book that's kind of based on history and sociology. And it goes on to explain kind of how certain areas of the world historically were able to kind of prosper based on their environmental areas, whether it was lush greenery, whether it was desert, and kind of how societies evolved over time based on where they were in the world.
Most exciting part of your job.
As of recently, I think, we're getting a lot of new structures, a lot of new opportunities to securitize asset classes, and that's obviously exciting. I think one of the more interesting and exciting parts of my job recently has been kind of more interaction with investors and doing more marketing for our CLOs that are coming out. I've had a couple trips to Tokyo recently to meet with banks, and that's always interesting to kind of go to new places, meet with new people, and learn new things.
And then final question, one prediction for the next 12 months.
Another Indiana Hoosier football championship.
That would be something
That would
to
be
go with the history that you guys have had and to win back to back. I think that would be quite the feat for sure.
fingers crossed. Fingers crossed. Actually, I think I'd rather see Indiana basketball make it back to the tourney before that.
There you go.
Beggars can't be choosers.
Yeah. Well, Seth, thank you for coming on the show. Congrats again to you and the team at Monroe, and you'll continue to success to you guys in the future.
Thanks again for having me on.
Of course. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.